You're listening to The Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, president and portfolio manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Friday, everybody. This past week, we were talking to a client who brought up the strategy of buying dividend-paying stocks as a strategy for building a retirement portfolio, basically taking income from the portfolio, buying blue chip stocks. And now, while this is not a bad strategy when it comes to investing, anyone who gives blanket advice, and when I say anyone who gives blanket advice, I mean professionals, financial advisory firms, and so on. So anybody who gives blanket advice and says it's a great strategy would also be doing the public a disservice if they didn't go through a few huge caveats that need to be thrown into the mix. So that's what we're going to be talking about today. We're talking about the good and the bad. So the objective, an objective look at buying dividend-paying stocks as a strategy for building a retirement portfolio. But before I start diving in here, as always, a few housekeeping items. If this is your first time listening or watching, thank you for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often, subscribe on iTunes if you're a listener, walker, treadmill, runner, or on YouTube if you're more of a watcher that likes to have your laptop on your lap or your phone, because we are both on iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koch and on Instagram at Financial Surgeon. And last but not least, all links, visuals, charts, and other educational resources are on our website. And while we will have a few charts here today, you know what? We'll go ahead and put them on the website. They're not crucial for the education that we're going to be talking about today, but I'll put them on the website just in case. So let's go ahead and dive into the material here. So I always like to start with quotes, and I've got two. And I apologize in advance because there are some explicit lyrics here in the second quote, but with the first one, the quote from somebody who we have no idea who said this, but I heard it a long, long, long time ago, and the quote goes like this. It says, "Dividend checks don't bounce." Obviously, that's a positive, right? It's basically, this quote's going to say that, look, you have a dividend-paying stock, it's paying you a dividend every quarter, those checks don't bounce, you keep getting that income, don't even have to worry about the price of the stock and what it's doing on any given day, week, or month. All that matters is you keep getting that dividend. So I wanted to have two quotes because I wanted to have one that lobbied in favor of dividends, and I wanted to have one that kind of lobbied against it. Now, the second quote comes from one of my very first mentors in portfolio management and technical analysis. And again, this guy is so quotable. I've got literally a list of quotes of things he's said that I learned from him. But this one in particular, so please don't get upset. I didn't say it, he said it. But Bob Kendall, he's an analyst and retired Merck trader. He said, "A dividend is a bribe to pay a piece of shit stock." So obviously this is a lobby against dividends, basically saying that maybe you shouldn't buy dividend-paying stocks just because they're paying a dividend. And again, that's what we're going to be talking about today. We're kind of looking at both sides of the coin, reasons for and against buying stocks that pay a dividend or building dividend-paying portfolios. So let's start with the good. So first and foremost, just to kind of get some basics here before we go crazy with all the details, the positives of dividend investing, first of all, generally, the companies that pay dividends are typically larger, safer, and what many might call blue chips, which, by the way, the name blue chip or blue chip stock comes from the game of poker, where the blue chips are the highest value pieces. So that's where years and years and years ago they started calling the big kind of bellwether stocks blue chips. Second of all, dividends can be $1 a share, 50 cents a share, $2 a share, $3 a share, $10 a share. But people aren't typically looking for a dollar amount per share in terms of dividends. They're looking for yield. They're looking for what the percentage I'm going to get based on how much money I invest. So if I have $1 million portfolio and I can build a portfolio of dividend-paying stocks that average, let's just say, a 3% dividend, then that would mean I could get $30,000 per year off my $1 million portfolio without even having to worry, per se, about the price of the stocks in my portfolio or the value of my portfolio at any given time, as long as, of course, those stocks continue paying those dividends. Now, today, the average dividend yield of the stocks within the S&P 500 is only about 2%. That's if you look at the highest dividend paying stocks all the way down to the ones that obviously pay no dividend at all. Now, some of the highest dividend paying stocks this year, which obviously fluctuate literally on a day-to-day basis, but generally speaking, earlier this year I pulled up a report, and Iron Mountain, Kinder Morgan, AT&T, Williams Companies, Altria, Oneok, Lumen Technologies, all of these companies are paying dividends, or at least recently were paying dividends close to 7%, in some cases over 7% per year in dividends. So those are some of the good things about it. Now, here's the problem, or what I call the dividend problem, the negatives of dividends. First of all, dividends can be cut. A company can decide at any point in time, whether it be due to market conditions, company problems, audits, that they just want to cut their dividend, and when they do it, they do it. It gets cut, and that's that. You don't really have any choice in the matter. Second of all, the price of a stock can go down, which means having nothing to do with the dividend, you can obviously lose principal when the price of the stock goes down. So now you might be thinking, well, yeah, but if I'm buying dividend-paying stocks, the whole point is I don't want to have to worry about the price going down, because if it goes down, at least I keep getting my dividend. But that takes me back to the first negative, which again is that dividends can be cut. So we can't look at them like it's a God-given right that we're going to get this dividend guaranteed for the rest of our lives. Another thing is when the price of a stock or your portfolio goes down, your dividend ends up looking larger, but only because you have less money. And let me explain what I mean by that. So let's just say, to build a study, call it a case study. Let's just say you have a $100 stock. When I say $100 stock, it's a stock that's trading at $100 per share. And if it's paying, let's just say, a 5% dividend, just to use easy math, then that means you're getting a $5 dividend. So $5 on $100 stocks, 5%. Now, if that stock drops from $100 per share down to $75 per share, first of all, if that's your only stock in the portfolio, obviously it shouldn't be, but let's just say it was. If the stock goes down to 75, that means you've lost 25% of your principal, first and foremost. But now your dividend is expressed as a 6.7% dividend. But the question is that a good thing? So again, $100 stock, $5 dividend, that's 5%. Stock drops from $100 to $75, but now it's paying 6.7%. Why is it paying a higher percent? Well, because dividends are expressed in yield as a percentage of the price of the stock. So if you take that same $5 dividend and you divide it into $75 a share, what you're going to get is 6.7%. So that's another problem. And when price goes down, which inevitably sometimes it does, and in worst case scenarios it goes down a lot, sometimes to zero, oftentimes when price goes down on a stock, the dividends get cut. And now what happens if the dividends get cut? We're not only down in our principal value of our portfolio, but we're also out of our dividends as well. So basically, if price goes down and then dividends get cut, now we're out of our dividends and our money. So that's kind of the dividend problem. And I wanted to share a few examples here. My first and favorite example is a company back in the day called American Capital Strategies. It was a mid-cap venture capitalist company that back in the call it first half of my career, between 2001 and 2007, we'll call it. This was a stock that would often come up in conversation because it was paying, generally speaking, over time, a 12% dividend. Now, 12% is awesome. I mean, if you can get a 12% dividend on a stock that goes nowhere every year, that's 12% per year. Who doesn't hate that? If you can get a 12% dividend on a stock that keeps going up, even if it's just 3, 4, 5% in capital gains per year, that's incredible. We want to own a stock like that, obviously, if we can get a hold of one. Of course, the problem that happened with American Capital Strategies is eventually it started having some troubles, especially after the last big economic crisis, which was the mortgage crisis between 2007 and 2009. And what ended up happening, and the funny story is, I had a client come into our office. I shouldn't say a client, it was a new client, prospective client, I should say, comes into our office, and this is in early 2010, I believe it was. And they said, "Hey, I've got this stock. I really, we're going to transfer our money to you. When we want you to manage our family's money, we want to do our financial planning with you. But we have this one caveat. There's this one stock that we love because it's paying a 24% dividend." And I said, let me guess, it's at American Capital Strategies. And the guy says, yeah, how'd you know? He was surprised. I said, well, because this is there's not too many stocks out there that pay high dividends like that, first of all. So it's not like there's a huge selection to pick from. But more importantly, I'd already known that, American Capital Strategies had gone down in value so much at the time that the 12% dividend it was paying beforehand was now 24%, not because they increased the dividend. It was paying a higher dividend because the price of the stock fell in half. So again, using that example earlier, the $100 stock. So remember I said a second ago, a 5% dividend on a $100 stock is a $5 dividend. So if the stock falls from $100 to $50 a share, now that $5 dividend is 10%, right? So just because you've got a really high dividend doesn't mean that it's a good, healthy company. And at the end of the day, American Capital Strategies has now been delisted. It doesn't exist anymore, and the stock just simply doesn't exist. So that's the first story. Some of the other ones, and you haven't heard of American Capital Strategies, I'm sure most people haven't anyway. But here are some other examples that I know you have heard of. First of all, General Motors and Chrysler. I put them both together because obviously they're both in the same sector. But no one ever thought that General Motors would go out of business. And the only personal story I have about General Motors is way early in my career, in the early 2000s, 2001, 2002. There were a lot of very high interest paying General Motors bonds out there, which if you don't know, then let me tell you that common stock owners, so people who own stock, are going to get their money after the bondholders get paid. So these were bonds which were supposed to be obviously even safer than owning General Motors stock. And to make things even better, this General Motors stock on this bellwether blue chip stock was paying 9% per year. It was incredible. I mean, again, who doesn't want to own 9% on a bond? Problem was, General Motors started getting into trouble, especially coming into 2006, 2007. But the price had generally been going down. General Motors peaking out in 2000 at about $76, $77 a share. And then by the end of 2001, it was trading as much as or I should say as low as $31, $32 a share. At the midpoint of 2003 or early part of 2003, General Motors was down to $25, $26 a share. Now it bounced and went up as high as $48. Just like in 2002, it had bounced and gone up as high as $56. But then it went back down again. So what we had generally was lower lows and lower highs in General Motors stock, which started telling us that maybe there's something wrong at General Motors. Now, I'm going to shorten this story up because it is a long story. But at the end of the day, what ended up happening was we asked all of our clients, hey, we need to sell all these bonds because even though they're paying 9%, we're all married to that interest rate because it's awesome. We've got to get rid of these things because we don't know what's going to happen to our principal on these. I believe they were BBB rated bonds. At the time, I can't remember exactly, so don't quote me, but we're worried we're going to lose the bonds, let alone the stock. So nobody that I was working with at the time owned General Motors stock, but we did own these bonds. So we sold all of them, except one client of ours who just wouldn't sell. He refused to sell because he just said over and over again, there's no way General Motors is going out of business. It just can't happen. This was before people started using that phrase, too big to fail. That's obviously become very popular now, and if you know anything or if you've ever read anything about finance and historical finance, then you know now that too big to fail is a pretty famous phrase. But in the end of the day, these General Motors bonds, not only did the stock go to pretty much zero and General Motors declared bankruptcy, but many of their former employees, especially ancillary places like Delphi, lost their pensions. And then the bondholders lost their money. Many of the bondholders lost their money as well. And so we lost, not only did General Motors lose principal, but then the dividend was cut. Then the dividend went away. Then the stock went to zero. The company declared bankruptcy. And then the bondholders lost all their money. Or many of the bondholders, I shouldn't say all of them, but many of them did. And to add insult to injury, not that this is pertinent to the story here, but then General Motors comes along a few years later and reissues a new IPO as a new company, still called General Motors, with a new stock, which is why if you're wondering, well, what do you mean they went out of business? There's still General Motors still exists today. You're right, it exists, but it's a new company. So it was a pretty big slap in the face to the prior owners of the stock. That ended up getting nothing at the end of the day. So anyway, so that's General Motors, and then Chrysler went through had a similar fate. Chrysler tried to make it after the 2007, 8, and 9 crisis. They just didn't make it through, and eventually they declared bankruptcy as well. Here's another stock that you may have heard of. It's crazy how much time's gone by, but WorldCom, purchased by MCI, ended up being called MCI WorldCom. Stock from the 80s all the way up into 1998, 1999, peaked north of $50-$55 a share, and then all of a sudden the SEC starts a probe, and before you know it, this stock goes down. And this was a too big to fail stock. This was a big, huge stock that everybody believed would be around forever. Every time it went down in value, people would buy more shares. Not everybody, obviously, but as it went down, people would say, oh, it's lower valued now. Let me buy more shares now. It's called averaging down, not usually a good strategy in my opinion. It's just my opinion. Then if it would bounce and head lower, people say, oh, well, it's an even better value now, and they buy it again at $30 a share. Then it's down to $15 a share. Dividends get cut completely. Stock goes to zero. They declare bankruptcy in, I believe it was 2004, and that's it. Game over for that stock. Well, what about Washington Mutual? I'm not sure how many of you have heard of Washington Mutual, but quick story. Again, one of the biggest companies in history, again, to go out of business. It had traded as high as $43 a share and change in 2007 before the mortgage crisis, and then it just tanked, went out of business. And again, we had another company, another bellwether blue chip stock that people felt would never ever go away, going to zero. And then we had Kodak, Eastman Kodak. I'm not sure how many of you are old enough to remember, depending, I know this is a podcast and not to stereotype, but usually it's younger people that are listening to podcasts. Maybe those of you that are watching on YouTube are of a different demographic. But anyway, I digress. Let me just shut up here before I get myself in trouble. Point being, I am old enough to remember using a camera with film, where if I opened up the back of the camera at the wrong time without rewinding the film, that it would ruin the whole roll of film. And I used to have to take my film to the local cord camera or CVS, and they would develop my film. And of course, there was always that person that worked at the cord camera CVS that probably knew everybody's secrets because they got to see everybody's pictures as they got developed. But it was a different time back then, and what happened with Kodak is they didn't change with the times. As times changed, they just kept sticking to their plan. Now, this was a huge company, traded at almost $100 a share for the longest time, and then before the dot-com bubble, which was Y2K, so before 2000, stock price starts to go down, and they just would not keep up with the times. So this was a stock that back in the day, people thought it's not going anywhere. There's no way this company goes down. I'm going to keep owning it. And again, if it goes down, I'm going to buy more. Because let's just say my principal's down in value, so I'll buy more shares and I'll get a higher dividend. But eventually what ended up happening at the end of the day is the stock just went to zero and Kodak went out of business. And that was the end of the story for Kodak as well. So one of the things I think that is scary to me is that we humans suffer from this thing called recency bias, where 2007 and 2009, that last mortgage crisis was a long time ago. But now, recency bias, and the mirage of safety persist as every time the market goes down, it comes right back up in 4 months or less. So I think the public, after 13 years of any kind of correction or recession lasting no longer than 2 to 4 months, I think the public and the investors of the world these days have forgotten the fact that even the biggest companies, even the safest companies, can too go under. And I think that the reason I wanted to do this podcast was not only to share both the good and bad about dividend investing, but to also share that it's not entirely guaranteed that just because it's a big company that we all believe in, that maybe we even think the government would bail them out. The government doesn't bail everybody out. And by the way, the government's bailed out so many companies at this point, so many public organizations, nonprofits, states, pension plans. We've got almost $30 trillion of debt in this country. And honestly, I just don't know how much more money they can afford to be bailing out private companies with anyway. But I digress, kind of going off the rails here. But in a market like this, stock market like this, the bottom line, I guess, is it's easy to get comfortable with these dividend payers, because if they're paying a good dividend, you get comfortable and you get that dividend, and maybe you feel comfortable with it. And I think with it, just recently there was a Kiplinger article that came out. I shouldn't say recently. This is a couple of years ago. I was reading a Kiplinger article, and it said, companies like Facebook, Eli Lilly, Bayer, Johnson & Johnson, Wells Fargo, AbbVie, General Electric, Delta Airlines, Lockheed Martin, General Motors, some of these companies, or all these companies I should say, were on a watch list for companies to, just be on the lookout for, and in the case that, these companies did end up failing, even though they seem like companies that are too big to fail. So there's still companies out there, and there always will be, by the way, that are never ever too big to fail. And so at the end of the day, I think it's okay to rely on dividends and building a dividend-oriented stock portfolio, or even an ETF portfolio with baskets of stocks that have high dividends. That would probably even be a better strategy, because at least it's diversified more. But again, bottom line, it's okay to rely on dividends, but you can't ignore price. You can't ignore price, and especially when price starts to go down, when the market environment changes and things start to look dark, you can't just turn a blind eye and say, well, my dividend will save me, because that's not always the case. Because remember, price can fall and dividends can get cut, and again, what we're left with is potentially no dividends and less money as well. So that is going to be our podcast for the day. Thank you so much for watching. Feel free to share this episode with your friends and family, and for those of you on iTunes, thank you for listening. If you'd like to discuss your personal situation further, please remember you never ever have to be a client to ask a question. If you'd like to set up an intro call or a Zoom meeting, you can just head over to our website, where you can click on a link to give you access to our calendar, or you can email us at info@libertaswealth.com. That'll come directly to us, and you'll get a human being who can, through email or call, to set up an intro call in person if you'd rather do it the non-electronic way. As always, I say that there's thousands of podcasts out there, and you chose to give ours a listen today. So again, thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube, which means you'll get these releases when they come out immediately. And remember, you can sign up at libertaswealth.com to not only get these updates for YouTube and iTunes podcasts and vlogcasts, but you'll also get updates to our other screencasts, videos, articles that we write, and they'll be delivered directly to your email inbox. Feel free to follow us on Facebook at facebook.com/LibertasWealth. I'm also on Twitter at Adam Koch, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.